Thanks for joining us for the Executive Series. Today I'm talking to Andrew Lockhart, who is the Managing Partner at Metrics Credit Partners. Andrew, good to talk to you.
Hi Tom, thank you.
Now, you've just announced a new capital raising, and this is of course for the Master Income Trust. Having just recently had the IPO, why are you seeking to raise an additional $300 million now?
Yeah, sure. It's a large scalable market that we operate in. It's a bank dominated market, and we see very strong interest from investors in terms of what we do. The unit price has obviously been at a premium to the NAV since we launched, and I think we've had a lot of inquiries from investors saying, look, we'd like to allocate capital to your strategy and get exposure to the asset class. But fundamentally, we have a strong pipeline of transactions, and we are seeing good demand from borrowers for our services and to provide funding to them. But more importantly, the amount of capital that we're able to look to raise, we don't believe will change the risk profile, nor will it change our ability to look to deliver on the minimum target return for our investors. So we believe that we can deliver the minimum return without changing the risk profile.
Of course, yeah, and the minimum return is the RBA cash rate plus 3.25%.
That's right.
So in this rising interest rate environment, we're seeing more activity globally. How's that translating to the Australian experience and demand for credit along the lines of the products that you're dealing with?
Look, I think one thing we deliver for investors is exposure to floating rate loans, and as a result of that, if interest rates do rise, then our investors receive the benefit of those rising rates in terms of increasing total returns. Unlike other asset classes such as traditional fixed income, if interest rates rise, the investor loses capital value. Here, there's no reduction to the value of the investor's capital. The total returns improve in line with rising rates. It is a bank-dominated market. It's a very large market, and really, we look to provide our investors with access to that market.
Okay, so tell us a little bit about the way that you've dispersed the proceeds of the IPO.
Yep. So when we launched MXT and listed in October of last year, we had a very strong pipeline of transactions, and so we've been fortunate that we've been able to continue to lend. So we lend to large public companies, to private companies. We do a lot of project and infrastructure, government PPP type funding. We provide a range of funding for property purposes, both for development funding and also for REITs. And we provide a range of acquisition facilities, predominantly to our private equity borrower clients.
Okay, so in terms of the growth pulse that you're seeing in the Australian economy, it seems to have turned a corner over the course of the last quarter in particular. Is that what you're seeing through demand for credit at the moment?
Look, I guess what we've not really seen is historically, over the last number of years, there's been really strong demand from companies that have been seeking to borrow money for growth purposes. Ever since the GFC, there's been, I guess, a little bit of additional slack in the system, and so people haven't been, or companies haven't been borrowing for CapEx purposes and the like. I guess for us, what we look to do is to provide our investors with a diversified exposure to Australian corporates, performing corporate borrowers, and we look to do that in a way that minimises their risk by ensuring that the portfolio that we hold in MXT is well diversified, and our investors are not exposed to the activities of any one individual company.
Indeed, and I suppose the point that you touched on previously, it's a bank-dominated market. It's very difficult for an average mum and dad investor to get exposure to this type of market, isn't it?
That's right. Our team have strong origination capability and skill sets, deep relationships with banks and borrowers, corporate advisors and others that allow us to originate and find good lending opportunities for our investors in MXT. I think what we're about, though, is just ensuring that our investors are exposed to a diversified pool where we're not concentrating their risk in any one individual company that we lend to. I think it's important as a lender that, unlike equities, we're not looking to provide our investors with significant upside. What we look to do is provide our investors with stability of capital and consistent income that flows from the lending activities that we undertake.
Andrew, it's good to talk to you. Thanks for your time.
Tom. Appreciate it.
And thanks for joining us for the Executive Series.